Hey, everybody. My name is Felipe Crook. I am super excited to talk to you about what the heck is happening with mortgage rates right now with a really great lender I've been working with for the last couple of years. His name is Marc Chamberlain with Origin Point Mortgage. Hi, Marc.
Hi, Philippe. How you doing?
I am good. I'm freaking out a little bit about what is happening with mortgage rates because I just saw yesterday that it's over 8%. Is that right?
Yes, in some scenarios, it can be over 8%.
That
Correct.
is crazy, 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 especially considering, January of 2022, they were at 3%.
Yeah, a lot has changed since then.
So, so tell me what you're seeing in the marketplace. Like you do this, you've been doing this for years and years and years. Tell me what is happening.
So what started all of this is obviously inflation. It got out of control, and now the Fed, I should say, is trying to get inflation under control, which, it's kind of a moving target. It's not something that can be done overnight, right?
Right.
So my my take on this is no matter the market, even when rates were in the twos and the fours and the fives, there's going to be a pro and con in every market. And in every market, even with rates in the eights today, there's a silver lining, right? So
Please
an
tell me what that
individual,
is right now.
well, for me, it's the opportunity to negotiate. It's the opportunity to talk to the seller, right? In 2020 and 2021, when rates were in the twos and the threes, a seller was not willing to negotiate, not willing to talk to a buyer. The sellers were getting 50, 150 offers in some cases. And then my buyers, they would have to spend maybe 200,000 to 500,000 over the asking price. So, that was all fueled with those lower rates. And, even sometimes some of those buyers, they had to waive all their contingencies. They had to waive loan, waive appraisal,
Mhm.
sometimes even waive physical. And I kid you not, I even had some people trying to get so creative as to, oh, we'll pay for your Netflix subscription or do something different just to get their offer accepted, but it
I
didn't
mean,
work.
it was so wild in those years. Like people were giving like, hey, I will babysit for a year. I will give you a new car, whatever they could do to get a property.
Right.
It was really, really insanity. And we actually worked on a few deals together where we
Yes.
we were able to get our offer accepted because you're able to do a loan in 14 days or 17 days. You can
10,
do
10 to 14,
10 to 14 days. You can get an appraisal done. This
72
shocked
hours,
me. You got one done in 2 days.
2 days.
That happened this
Yeah.
year. I was
Yeah.
blown away. But
Thank you.
yeah, you did a great job. And it was one of those things where like we threw everything at the kitchen sink or everything at the wall just to see what would stick. And
Right.
sometimes we would get really lucky and a seller would accept our offer because of the terms we put in. But
Yes.
now it's weird because in some neighborhoods in Los Angeles, we're still seeing multiple offers, which shocks me, even with an 8% interest rate. But there are some areas that you're starting to see more price reductions, more seller concessions, and some negotiating that a buyer did not have a year ago, even 2 years.
Exactly. Exactly. And uh, every buyer that I speak to today, every consultation I have with them, I always ask them, look, are you in this market to get a rate or to get a house? Because if you're in here to get a rate, this may not be the time for you,
Yeah.
right? And then when the rates drop to a level where they're comfortable, if their goal is to get a 4 or 5% rate, if that is their goal, now hypothetically, if that did happen, that means you're going to have to pay more for that house, and you're going to go back to those multiple offers and back to waiving everything, and then you're having to pay more for the house. Right now, even though the rates are in the eights, you may be up against 10, 15 individuals, some cases even less. It just depends on the area, like you said. But
Mhm.
the opportunity to talk to the seller and to negotiate with the seller, I think, is very valuable. And I think that was overshadowed by the twos and the threes in 2020 and 2021.
I want to go back to what you said there. So typically in a normal market, what happens when interest rates go up, it tends to put a downward pressure on pricing.
Right.
Which we did see at the very beginning of 2023, when interest rates were starting to peak up. There was definitely some downward pressure on pricing because people thought that, oh, the market is going to tank and inventory is just going to skyrocket. But the inventory actually went down against what most major economists predicted.
Right.
So it was kind of a weird marketplace. So prices did go down a little bit, but then they started creeping back up. So the last 6 months, we have seen appreciation over the last 6 months, even with interest rates over 7%.
Right.
So the logic behind this is if you think that as interest rates start to go back down, those prices are going to get accelerated because more people are going to jump off of the sidelines and back into the market. They're going to start competing and you're going to get multiple offers all over again. So for those people who can qualify now with these rates,
right,
you're not going to be able to negotiate the same kind of deal when rates are at 5.5% or 6%. You're just not going to be able to do that.
You know, Felipe, on that note too, there are ways to, if you can qualify in this market, right? There are ways to weather the storm on a loan program. The most popular loan program that I'm seeing today that individuals are taking advantage of is called the temporary buydown programs. The most common one is known as a 2-1 buydown. We have a variety of other buydown programs. There's I like to call it the holy grail of all buydown programs, temporary buydown programs. It's the 3-2-1 buydown, which is amazing.
Can you explain what that is? So there's two different ones you're talking about. 3-2-1 buydown, which is like the holy grail.
Right.
And then the 2-1 buydown. Tell me exactly what that means for the buyer, for the seller. What does it mean essentially for the program?
Yeah. So what it means is that there's your effective locked-in rate today, right? And let's just say hypothetically that locked-in rate today that you're being qualified at is 8.5%. So on the 2-1 buydown, it just essentially means that if the seller is willing to credit a certain amount of money toward the buydown, then the seller or then the buyer can take advantage of the 2-1 buydown. And essentially what it means is that in year number 1, the effective rate of repayment for the buyer will be 2 percentage points lower than your locked-in rate today. So it would be 6.5 in that example. And then in year number 2, it's going to be 1% lower than the locked-in rate today. So it's going to be 7.5%. And then from years 3 and beyond, it's still the regular payment that we qualified the buyer at. So the seller credit, let's just say the seller credit was $13,000, right? That money's held in a reserve account at the lender where they're making their mortgage payment. And every single month as they make their payment, their effective rate of repayment in year 1 is at 6.5. That subsidy is being pulled from that reserve account that you were able to get for the buyer. That $13,000 is being pulled. It's not a savings account where they can withdraw from or nothing like that. So, so it sits there very similar to an escrow impound account. It works the exact same way. The beauty of this is that, let's just say by some miracle, a year from now, rates do drop. Let's just say rates drop to in the low 6s. They can always refinance. There's no prepayment penalty. So when you refinance, whatever amount of money is left in that temporary buydown account at the loan servicer, if rates are at the low 6s, you can always refinance. And then whatever money's left in that buydown account would be applied as a principal reduction on the mortgage. Yes. You never lose it.
I didn't know that.
It's never gone. So the 2-1 buydown is very common. You can do a 2-1 buydown on a conventional loan, an FHA loan. You can do it on a VA loan. You can even do it on a jumbo loan. And guess what? You can even do it on a non-QM loan, which is a bank statement loan. So, and to be honest, the biggest opportunity I am seeing for individuals entering the market today is for those individuals that are entrepreneurs, that are working in an industry where maybe they're an independent contractor, they're self-employed. I don't care if you're a social media influencer, if you are in the cannabis industry, if you are an OnlyFans model, whatever it is, you're making money, but they're not showing a lot of money on their tax return. We can always use bank statement loans, P&L loans, a variety of other loan programs to help them get qualified. And the reason why there's this opportunity is because sometimes those loans, they do take a little bit longer. They may take 30 days. So the need for the speed in this current market may not be there. If you're within the seller's ballpark of getting the offer that they want, they'll wait 30 days.
Sure. Okay, so
So
I mean, you just gave a lot of really good info there. First of all, like you have a ton of different loan products for
yes,
people who are not a typical W-2 borrower, which is great.
Right.
There's a lot of
Right.
people who are independent contractors, freelancers in Los Angeles, or business owners who
Right.
have a lot of cash flow, but they write off a lot in their expenses. So
Right.
they could get a loan, a bank statement loan, where they're showing income coming in, and they don't have to go through a formal W-2s or tax returns in order to get their loan.
Right. We don't even look at the tax return.
And this 2-1 buy down will actually work on those type of loans as well.
Correct.
That's
It works
great.
in the non-QM sector. It works only with the bank statement loan.
Okay.
So there's a lot of advantages of still trying to negotiate something for you in this market. And I always preface everything by asking an individual, look, are you seriously committed into purchasing a home? Is that a true goal? Because if it is, you and I can get them there, right? We just stay away from the negativity and the static noise of everything that's happening. Yes, we do know rates are where they're at, right? We do know inflation is everywhere, the cost of gas, food, groceries, everything's up right now.
I mean, just the cost of housing in Los Angeles in general is ridiculous.
Yes, it is.
But there are ways to get into a property, but you have to have the desire, first of all, and then you have to have a good team that can now help you navigate through. It's complicated, and
Very.
having all of the tools in your arsenal was really helpful.
Yeah,
So-
and the other thing too, if I may, is what we started to do as of recently is because we know a lot of individuals are maybe interested. They want to maybe stick their toe in the water and just kind of see what it is. So what we've done is we've started to do what's called a soft credit inquiry. So it'll still allow us to look at a version of a credit report so we can see what other debts are on there and what the potential credit score is. It does not affect their credit. So I could still pre-approve somebody based upon that soft credit inquiry if they want to test the market, see how it is. And then once they get an offer accepted, then at that point, we would have to do a regular traditional credit inquiry.
A lot of buyers are, I'm this is kind of a random tangent, but a lot of buyers are very concerned about their credit being pulled when they're applying for a mortgage, or like, oh, I don't want to get my credit pulled. How much does that actually affect your credit score when you do a mortgage inquiry?
The irony of that is it really doesn't. It's like, if you go to the doctor wants to diagnose your situation, they have to do a blood test. I hate needles. So for me, that's very painful, but I metaphorically, I equate that to, if I'm trying to help someone to diagnose their mortgage plan, then to me, like the blood test is the credit report. It has to get done. It's a one-time thing. It's good for 4 months. And even if you're still looking 2 or 3 years down the road, the worst case scenario is that we would have to look at it again. But now that we have that soft credit inquiry option, that's a mute. It's not anything they're going to have to be too concerned about because it doesn't need to be done.
That's really great.
And then what really happens is once you do have a credit inquiry, if it's mortgage to mortgage, you have a certain time frame, which is usually about 3 weeks, where you can look and have your credit ran, and it's going to look like the same credit inquiry, right?
So you can shop lenders if you didn't, just to give them, not that I want them to shop around, But they want to know that they're getting the best possible deal. So they talk to multiple lenders and then they get,
Correct.
the best deal. It's always really good to make sure that you're actually talking apples to apples instead of apples to oranges, because lenders can be a little shady. That's why I always like to work with you and a couple other of my preferred lenders, because I trust you. I know you guys, and I know that you guys are really honest. And that's like critical in
Right.
building trust with a client.
Yeah, no, and I couldn't agree with you more. It's when an individual, like for example, we're going into the holiday season, you're going to see a lot of department stores advertising, hey, get 20% off with this purchase for, Black Friday, whatever. Some individuals always around this time are going to apply for that department store credit card just to get that 20% off, which it doesn't really make any sense. But when you deviate and you go from mortgage inquiry to department store to auto loan, that's where your credit score will drop. So
that's good to know.
Going into this time of year with the holidays, I tell everyone, just don't apply for that department store credit card, no matter how good it is. You know what I mean?
Yeah. That is really important. Like if you were buying a house, do not do anything with your credit. Don't apply for any, don't get any new loans. Don't get a new car. Don't apply for furniture, layaway, nothing. Just do nothing until you've closed on your property.
Here's a little credit hack too, since we're talking about credit. Like my wife and I have all of our regular household expenses. We pay it as much as we can on our Amex so we can get the travel points, right?
Mm-hmm.
So what I personally do is every day or every other day, I'll go in and pay those debt balances down to zero. So Amex doesn't make any interest on me. Sorry, Amex. And I'm still getting my points, right?
Yeah.
And then more importantly, the credit bureaus will never know a true balance of what I'm accumulating every single month, because I'm always knocking it back down to zero every few days.
Smart.
So you can use your credit card, but then check your app. Everyone has a cell phone, a smartphone nowadays. Well, most people, and you can go in there and just pay down when it's a couple $100. You don't have to wait until it's $4,000 and then it gets reported to the bureaus. Now your credit score takes a hit, and then you're going to have to wait another month or so before it to get updated.
See, these are kind of tips that I talk to buyers when I'm telling buyers, hey, I want to buy a house in a year. And I say, talk to a lender now. Right. Because these kind of tips are really important. And the game plan that you have to put together, especially if you're buying a property in California is super expensive. If you don't have a plan and how to get there, it's never going to happen. But talking to a lender, you guys can give them the pathway of what they need to do, how much they need to save, what kind of loan programs they need to do. If you have any credit issues that you guys have to work on, you can start doing that stuff now. So all your ducks are in a row in a year when you're ready to purchase. So the other thing, so going back to ways buyers can help save money on their mortgage payments. So you have the 2-1 buy down. You also have a 3-1 buy down. What's the difference? I'm sorry?
3-2-1.
3-2-1 buy down, excuse me. 3-2-1 buy down and a 2-1 buy down. Why would a buyer rather do, let's say you have a $1 million house and you're able to negotiate a sales price of like $970. Why would a buyer want to pay $1 million and get $30,000 from the seller versus just getting a lower price on the property? Like, aren't they going to pay more on the property if they have a higher sales price? Like, I get that question a lot. So
that's a good question. So I'm just breaking this down at your 970 really quick. Let's just say they put down percent. That's a loan amount of 3, right?
How much? So, did they put down how much?
10%.
Okay.
So that's a loan amount of 873. Let's just hypothetically say the going rate was 8%. So if they're going to do a 2-1 buy down, they would need to have a seller credit of somewhere around $22,000, right?
Okay.
That seller credit of $22,000 is going to offer them a lot of relief over the next 2 years, right? Personally, my personal belief is that I do think rates will start to drop within the next 2 years. So that's going to give them a huge sigh of relief within those 2 years, right? So there's two ways you can go about doing this. If the buyer is having to pay more to incorporate the buy down, right? The only thing that is really changing is, number one, the appraisal would need to appraise for the price of the home, okay? Which, using your example at 970, let's just say, again, my example is 22,000. So let's just say now you have to raise the purchase price to 1 million. Property taxes, you're going to see it. The monthly payment on the property taxes is going to change maybe about 25, 30 bucks, if that, which is not a lot, right? Versus you could save, looking at my cheat sheet here, you could save about $1,172 within the first year if you get the buy down, right?
A month?
A month.
Okay, so if they just got the lower rate, if they just got the lower price, let's say they just offered 970 and they paid their own closing costs.
Got it. So you got a price reduction.
Yeah.
So the only thing you've done by getting the lower price is you got the lower price. So all you've really done is saved yourself money on property taxes, right? So,
well, and the mortgage payment.
And
right?
the mortgage, you got 30,000 off the price. You got a potentially lower loan amount to start with, right? But the only other thing that changes on the monthly side is your property taxes, your PMI ratio, which is going to change by a few dollars. You know, the difference in that is just a few bucks. So maybe you saved yourself about $30, $35. I'll even give somebody the benefit of the doubt. Let's say it was 50 bucks. You saved yourself 50 bucks, right? In that example, on the monthly side.
Well, plus the $30,000 less in your loan, right? So it would be what, 240 bucks ish on your mortgage payment. True. So maybe 300 bucks difference between 970 and $1 million. But the buy down, you're saying if they apply that buy down rate, they would save $1,100 for the first year, a month.
Correct.
So the difference is $800 a month for the first year, which adds up significantly over.
So here's the difference in the down payment, as you mentioned, right? Let's just say 970 again, 10% down. That's $97,000, right? If you had to inflate the price to incorporate a buy down, let's just say it was $1 million, 10% down is what? $100,000.
Right.
What is the difference in the down payment? $3,000.
Right.
So you've already, if you're buying the home, you've already allocated a certain amount of money for the down payment. So that is already a given. So you've already committed to spending that amount of money. In that example, it's $3,000 more. But if you do that extra $3,000, you're going to save $1,100 a month. You're going to recoup that money within 3 months. So very easily. Now, one thing I know about LA is that it appreciates like no other area.
It's a different beast.
It's a different beast. And that's the one talking point I don't hear a lot of chatter about. Like everything is overshadowed by the 8% rate, right? Yeah. But if you do buy that $1 million property today, what do you think that home is going to be worth within 2 years?
Yeah. I saw this crazy statistic. I'll try to find it and post it on my social media that said over the last 30 years, the real estate in California has appreciated 297%.
Yes.
297%, which is
great.
Absolutely insane. And that's historically, properties always appreciate. Like they just always appreciate. You know, if you look back 50 years, they've always gotten more expensive as they go along. So I think
that is so true.
You have to have a long-term mindset when you're thinking about real estate.
You do. And then also the other mindset to have is, I know with first-time home buyers, especially when you're entering the market, it's your first home. I always ask them, how long do they envision themselves being there? Because the average person in the United States is refinancing or selling every 5 to 7 years.
7 years. Yep.
And the biggest question I always get, what can I do to pay down my mortgage, right? Can I do biweekly payments? Can I add extra principal? But keep in mind, those theories only work if you're committed into staying in that same loan for the full 30 years. I've been doing loans for 20 years, and I can count on one hand how many people I know that have paid off their mortgage.
Yeah.
And I still talk to those same individuals, and it's a kind of an irony, because people, you have equity, and then a life event happens. Maybe you have a child that's going to college, or you've racked up credit card bills. You can tap into the equity. You can use a home equity line of credit or do a cash out refinance, and then you can pay off some of that debt and get that, the interest written off on your tax return. And the best thing about it is when you do a refinance and you borrow against your home, guess what? It's not a taxable event. You don't have to pay taxes on that money. So in some ways, with, for example, a vehicle, you pay down the balance on your car. You just pay down your car. It's a depreciating asset, not a home.
Right.
So
yeah, I mean, the fastest way to long-term generational wealth is through real estate. And I keep saying that over and over and over again, but the hardest part is just getting into it in California. Once you're in it, you have a little bit of flexibility. You'll have some appreciation, you'll put some sweat equity into a property, and then you can use that money and then move around, so just getting in is the hardest part, and it won't happen without a plan.
One of the exciting things that just happened recently was that Fannie Mae announced that
let's talk about this.
They're going to allow 5% down on 2 to 4 units, which before that was 15% down on 2 units. By the way, this is all owner occupied stuff. And then on owner occupied 3 to 4 units, it used to be 25%, but now it's going to be 5%. And the best thing about this is that most people used to have to go FHA because FHA had to do 3 to 4 units, but FHA has what's called a self-sufficiency rule on 3 to 4 units, where it just means that the going market rent needs to cover the full mortgage payment, including taxes and insurance. And if you're putting down 3.5% on a $1.5 million property, you're not going to cash flow.
No way.
But Fannie does not have a self-sufficiency test. So huge. This starts November 20th, and I'm super excited about it because I think going into 2024, it's going to give a lot more individuals an opportunity to go out there and buy units, which the more doors you have, the more opportunity you have to generate additional income, which I think is huge.
Yeah. So those, the barrier to get into a property is really high in California. But if you have 3 other people helping you with your mortgage, it makes it, first of all, a lot easier to qualify. The loan limits are way higher for 3 units, for duplexes, triplexes, and fourplexes versus a single family home in Los Angeles. Right. And you get to live in the property and somebody else helps you build your equity until you're at the point where if you want to rent that out and then take that equity and move to another property, or just keep it as an investment property. Like it is a great
after 1 year. After 1 year.
After 1 year. Yeah. You can tell me all the rules and I'll just follow. Yeah, that's a huge. I just did a video about that on my TikTok about it just opens up so many doors because a normal home would be, previously it'd be 25% down on a threeplex and a fourplex, right?
Correct.
Now it's 5% down. Like that is monumentally different down payments, and it can get a lot of people in there. I think it's a great idea.
And not only that, when it comes to the rent on those other units, we can always use 75% of the going market rent for income to qualify the buyer. So they get extra income help on that too. So I think that's one of the best news I've heard this past week.
Yeah. I mean, thank God there's got to be something good.
Right. Oh, and then the other thing that's happening that's going to be coming up is usually toward the end of the year, sometime in November, which is right around the corner, Fannie Mae, Freddie Mac are going to announce their newer conforming loan limits for 2024. So right now it's currently set at 1,089,300 for a single unit property. That amount is going to go
LA
up
County, right?
in LA County, Orange County.
Orange County too?
It's in what's called high balance areas.
Mhm.
But we've already started on the lower balance areas. Right now it's currently at 726,300.
Mhm.
We've taken a preemptive measure to raise that limit to 750. So if somebody wants to buy like in San Bernardino or Riverside, like Palm Springs or something, then, it may help them just, get to where they need to be. But the official announcement is coming in November. So stay tuned for that.
Do you think that they will go up in Los Angeles?
Yes, they always do.
Oh, I mean,
Always.
that's great because pricing keeps going up. And the difference between the reason why this is important is because the difference in conventional financing rules versus jumbo financing rules, it's a lot harder and you have to provide a lot more documentation, a lot more reserves for jumbo loans versus conventional, correct?
Yes, and I'm glad you brought that up actually, because I wouldn't want anyone watching this to be afraid of a jumbo loan. A jumbo loan is technically anything that's going to be an ARM, right? An adjustable rate mortgage, because it's called a non-conforming loan, essentially.
Wait, an ARM is considered a jumbo?
It's considered a non-conforming loan, which is underwritten like a jumbo. As soon as you say you want an adjustable rate mortgage, now you need to meet all the other criteria of the same thing like a jumbo loan.
I didn't know that.
Which most people do not know on an adjustable rate mortgage is, for example, if the 7-year fixed rate, the 7.6 ARM rate today, let's just say it was at 7.25%, right? That's what you see, and that's what you see on your note. However, when the underwriter is qualifying the individual on some loan programs, the underwriter has to qualify the buyer at what's called the fully indexed rate. Fully indexed rate could be somewhere in the 8s or 9s in this current market. Wow. So that could actually diminish and lower your purchase power because you're being qualified at a higher rate of payment, which people will only see or hear, oh, I can get a lower rate on an ARM. Yeah, it's true. That's what you see, but you're being qualified at a higher rate. So maybe it doesn't work out. And pricing today is, honestly, it's better on a 30-year fix versus an adjustable rate.
What? Are you kidding?
The reason for that is because in this current market, in the secondary market, investors that insure these mortgages know that individuals are going to refinance as soon as they get the chance. Yeah. So in a lot of loans that we're seeing today, on some of these loans, the individual has to pay what's called discount points, which is a percent of the loan amount. So if you have a 500,000 loan amount, if someone says you have to pay 1 point, that's 5,000 that gets added to the closing costs, which, going back to the opportunity to negotiate, you can also try to get the seller to offset some of those closing costs because it exists in this going market. A lot of people don't know that or take advantage of that opportunity, but pretty much everything is negotiable, which is where you come in to, you can help the buyer negotiate those terms, right? Yeah. So I think there's a lot of misconceptions on jumbos, but the biggest thing to know is that on a jumbo, it's going to be very specific to the loan investor, which typically means sometimes you may have to verify your rental history going back 12 months. You're going to have a lower debt to income ratio, it's usually 43, 45%. And then you're going to have to show what's called reserves, which is 6 to 24 times the mortgage payment in reserves, which means you have to have that left over after you've applied your down payment and closing costs. Yeah.
Which, I mean, that'll eliminate a lot of people right there.
It does.
Yeah.
And I've seen a lot of people that are entering the market in LA. They're asking family for help. They're getting gift money, which is allowed. Christmas is coming. The holidays are coming. So instead of asking for a gift, ask for gift money.
Can I have a down payment, please? Yeah, that's a lot of Christmas present for a down payment. Okay, listen, I really appreciate you and your professionalism, and how you're a very genuine, nice person, and I really enjoy working with you. And you give me lots and
Likewise.
lots of great information. So how can people get a hold of you if they want to refinance, if they want to purchase a home, or if they want to ask you questions about mortgages?
The best thing and thank you also, I appreciate you too, Philippe. The best way someone can get a hold of me is they can call me at my cell or text me 318-27629. You can go to my Calendly page. It's just calendly.com/mortgage Mark, and it's Mark with a C, not a K.
Mortgage Mark with a C. And
Yeah.
give me your cell one more time. I think it just bleeds out over time.
I wish I could pop it up here. It's
I know.
310-382-7629. The last tip I wanted to provide you and anyone else watching this is you can follow something that's called the 10-year treasury bond. I look at it all day, every day. You can follow it just like a stock on Yahoo Finance or wherever you want to use. Like currently, as I'm speaking to you, it's at 4.91. The spread and the margin on that currently in this market is around 3.00. So if you ever want to have an idea what general conventional rates are doing, add about 3.00 to that, and that'll give you a good idea as to where rates are at.
That's a good little tip. And I can just find that anywhere on just Google treasury yield.
Yeah, I can actually, I'll send it to you.
Okay.
It's really easy to find.
Okay, cool. Well, Mark, again, I really appreciate it. If you guys have any questions for Mark or me about real estate and Mark about mortgages, feel free to reach out to both of us. My phone number is 213-268-6832. I'm with EXP Realty here in the greater Los Angeles area. Mark, again, thank you so much for your time and your great information. And I hope you have a fabulous day.
Thank you, Philippe. Talk to you later.
Okay.
Bye.